If you woke up this morning holding silver, you didn't just lose money, you lost certainty. In a matter of hours, a metal that's supposed to protect you in chaos collapsed nearly 40%. And the reason isn't what headlines are telling you. This wasn't panic. This wasn't manipulation. This was policy. And it started with one name. Silver doesn't move like this without a message. 37% doesn't seem to evaporate because of a bad jobs report or a random futures trade gone wrong. When a market that deep snaps that hard, it's reacting to power shifting behind the scenes. And that's exactly what happened. Investors weren't reacting to silver itself. They were repricing the future. A future suddenly rewritten by a single decision tied to Donald Trump, as expected pick for the Federal Reserve. For years, silver has lived in the shadow of easy money, low rates, loose liquidity, endless reassurance from central banks that inflation would be tolerated, even welcomed. That environment made hard assets shine. Gold led. Silver followed with leverage. It wasn't just an industrial metal anymore, it became a monetary hedge, a vote against discipline, a bet that the Fed would always blink first. That assumption just cracked. When news began circulating that Trump's preferred Fed pick wasn't a dove, wasn't a compromiser, but someone openly critical of balance sheet expansion and emergency-style monetary policy, the market didn't wait for confirmation. It didn't wait for hearings. It didn't wait for inauguration. It moved immediately. Because markets don't trade the present. They trade credibility. This wasn't about Trump as a person. It was about what his pick represents. A hard pivot away from the post-2008 playbook. A signal that rate cuts would no longer be automatic. That liquidity would no longer be infinite. That inflation would be fought, not rationalized. For silver, that's an existential threat. Think about it simply. Silver thrives when real rates are negative, when cash is trash, when holding dollars feels like standing still on a down escalator. The moment investors believe that real rates might actually stay positive, that holding cash might pay you again, the math changes, fast. The speculative premium embedded in silver gets stripped out brutally, and that's exactly what we saw. This wasn't long-term holders quietly selling. This was leveraged money rushing for the exits. Futures unwound, options cascaded, margin calls hit. Once the first wave broke, the rest followed. Because silver is thin compared to gold. It doesn't absorb shock, it amplifies it. What made this drop feel so violent wasn't just the percentage, it was the speed. No slow bleed, no orderly rotation, just air pockets. That's a tell. It says positioning was crowded. It says too many people were leaning the same way, confident the Fed would always protect them. And the moment that belief was questioned, the trade collapsed under its own weight. This is where most commentary gets it wrong. They'll blame algorithms. They'll blame China. They'll blame a mystery whale. But whales don't dump unless the tide turns. And the tide turned because policy expectations flipped almost overnight. From accommodation to restraint, from stimulus to discipline, from rescue to responsibility. Silver didn't fall because demand vanished. It fell because belief did. Belief in the Fed's old reflexes. Belief that political pressure always wins. Belief that inflation hedges are a one-way trade. That belief is now being reevaluated in real time. The market is forcing everyone to confront a very uncomfortable question. What happens to asset prices when the Fed stops being your safety net? That question doesn't just affect silver. It affects stocks. It affects crypto. It affects housing. Silver was just the first to blink. And when a market that sensitive blinks this hard, it's usually pointing at something much bigger underneath the surface, something most people still aren't prepared to fully process because everyone assumed the rules hadn't changed. Investors, analysts, even hedge funds were still operating on the old script. Low rates forever, emergency liquidity as a safety blanket, and markets that always rebound when pushed to the brink. That script just got shredded. And silver is the canary in the coal mine. Its plunge isn't just a number on a screen, it's a signal, a warning, a real-time confirmation that the Fed's future path may be far less predictable, far less forgiving, and far more disciplined than anyone expected. The speed of the drop caught even seasoned traders off guard. Margin calls rippled through accounts, forcing forced liquidations. ETFs that track silver were hit like dominoes. And retail investors, who often buy after a surge, were left trapped watching their portfolios evaporate. It's a stark reminder that markets are not playgrounds, they're leverage machines. And when leverage meets sudden uncertainty, it doesn't whisper, it screams. Yet, the story goes deeper than just mechanics. This move also exposes a generational shift in central banking philosophy. For decades, the mantra was clear: intervene first, apologize later. Stimulus was the default, bailouts were the norm, and as long as that framework held, assets like silver thrived. But Trump's Fed pick signals a potential break from that orthodoxy. It's a pick that values fiscal responsibility, scrutiny of balance sheets, and above all, a willingness to let markets breathe, even if it means short-term pain. For markets, that's terrifying. For silver, it's existential. The industrial angle adds another layer. Silver isn't just a hedge, it's an industrial metal. Its demand comes from solar panels, electronics, medical devices. When prices move violently, industrial users pause, they hedge, they substitute, and that creates feedback loops that exacerbate the move. So, while headlines scream about investors' panic, the reality is a combination of financial speculation, industrial recalibration, and most importantly, policy-induced fear. Now, let's talk about timing. Why now? Why this pick? Timing is never accidental in Washington. The Fed's next chair will shape markets for years. Appointments like this don't just affect interest rates, they reset expectations for inflation, liquidity, and risk premiums across every asset class. Investors know this. That's why silver was not just sold, it was liquidated, not in weeks, not in days, but in hours. Because the market isn't patient. It prices in perception before reality. The reaction also highlights something investors often forget. Psychology drives markets as much as fundamentals. It's not just about balance sheets and rates, it's about trust, confidence, belief. Once those are shaken, panic amplifies every move. And nothing destroys confidence faster than a sudden shift in central bank philosophy paired with a market already sitting on crowded positions. Silver didn't just get sold, it got abandoned. And that abandonment speaks louder than any analysis. We're seeing a chain reaction that will ripple far beyond silver. Commodities are recalibrating. Precious metals, ETFs are under pressure. Hedge funds that relied on easy-fed liquidity are rethinking strategy. Even traditional safe haven plays are being questioned. This is why the drop is being called historic, not because it's the largest number, but because it reflects a structural change in how markets perceive risk. The metal is screaming. Nothing is guaranteed anymore. Not rates, not liquidity, not even political predictability. And that's the lesson most media outlets are missing. They focus on the dramatic percentage or the trading charts. They show red lines plunging. They sensationalize. But the real story is deeper. This isn't a momentary correction. This is a shift in the financial DNA of the market. Silver is just the loudest signal, but it's not the only one. Investors, institutions, and even governments are now reevaluating assumptions that have guided decisions for over a decade. That kind of reassessment doesn't happen quietly. When belief in automatic safety nets disappears, every position must be questioned, every hedge recalculated, and every assumption stress tested. That's why some of the biggest players in the market didn't wait for confirmation. They acted immediately. They understood that a Fed pivot isn't just a policy change. It's a seismic event. It's the difference between surviving and getting crushed. And silver, with its unique combination of monetary and industrial roles, became the first and most visible victim. This moment also exposes an uncomfortable truth about speculation. Many investors forget that silver's allure isn't just about its shiny appeal. It's about psychology and leverage. For years, people bought it, not because they needed it, but because they believed it would always rise when the world seemed uncertain. That belief created a self-reinforcing cycle. More buyers, higher prices, more buyers. But cycles like that don't end with a whisper. They end with a shock. And the shock came faster than anyone expected because confidence evaporated almost overnight. We also need to consider the geopolitical angle. Trump's Fed pick isn't happening in isolation. Markets are sensitive to global tensions, trade negotiations, and fiscal policy. When you layer in the possibility that rates could rise and stimulus could shrink while global uncertainty remains, it creates a perfect storm. Silver, always sensitive to macroeconomic turbulence, became the first to reflect this new reality. Investors are realizing that holding precious metals isn't just about inflation anymore. It's about understanding policy shifts, political intentions, and global market interconnections. Then there's the role of leverage and derivatives. The futures market in silver is thin compared to gold, making it far more reactive to large trades or sudden shifts in sentiment. When leveraged positions unwind, it creates cascading liquidations. Each margin call triggers another, and the move snowballs. That's why a seemingly small policy signal can translate into a catastrophic price movement. In this case, the markets weren't just adjusting. They were recalibrating under extreme stress, highlighting vulnerabilities that had been building silently for years. Retail investors, in particular, are often the most exposed in these situations. Many entered the silver market during the surge over the past few years, drawn by the promise of fast gains and the idea of a hedge against the system. But when policy shifts, those who don't fully understand leverage or timing are the first to feel the pain. This drop isn't just a lesson in market mechanics. It's a lesson in awareness, patience, and respecting the unseen forces that drive asset prices. It's a wake-up call that markets are far more sensitive to expectation shifts than actual events. Finally, we must acknowledge one critical point. Volatility isn't the enemy, it's a signal. The violent drop in silver tells us something essential about the market's perception of the Fed, of policy discipline, and of risk. It forces a reevaluation of assumptions. It challenges complacency. And while the losses are real and frightening, the message embedded in this crisis is invaluable for anyone who wants to navigate financial markets successfully. Silver didn't just fall, it spoke. And those paying attention will understand what it's saying. The era of guaranteed safety nets is over, and markets are learning that lesson in real time. This is where we leave it for now, because the next part is about what comes after the shock, the reactions, the implications for other assets, and why this could mark the start of a much larger financial realignment.